I have to follow to my, to the speakers speaking in the morning, and particularly Professor Tsokomos and Dr. Richter, because what they were covering in their speeches is basically exactly what is reflecting my practice by being the expert witness dealing with valuation of assets in insolvency. And the point Professor Tsokomos made was that the accounting value is not that accurate, that the equity value when it comes to the real market valuation. This is what I fully agree with. And this is an internal problem of financial reporting as such, as also I'm going to show later in my presentation. And the very important point Dr. Richter made was that there is the demand for the insolvency law make-up in the Czech Republic, particularly in terms of the valuation approaches. So what is the correct valuation approach applicable in the situation of insolvency where the assets are going to be valued? Then Mr. Lalka made a very great presentation. I'm very engineer Lalka over there. It was an excellent presentation, extremely to the point. And what I would like then to take from your speech, again related to the topic of mine, is the complexity we have to face and the dynamics we have to face, and also how people is extremely smart in various situations, and the regulation and also the financial reporting is unfortunately not good enough to reflect the complexity of the economic world, of the real world. So this is the phase before it comes to the point where the company is becoming insolvent. Later on, of course, we have to deal with another qualitative issue, and this is the cooperation with the court, where also mostly the judges are not economists, being familiar with what the economists consider relevant and important. So over-indebtedness, basically in the Czech law, is a balance sheet test, right? And with a balance sheet, we have two issues. And first of all, this is the quality and availability of information. And arising from the quality and availability of information, we face all the issues Mr. Lalka covered in his speech. And the other issue, and this is the issue of my interest, are the fundamental principles of how accountants look at business operations and how economists, or if you want, investors, look at business operations. And this is particularly from the business valuation perspective, that assets are classified according to their risk and income generating potential. So all the people experienced in investment banking or transactions, they know that we classify excess cash, first of all. We make a difference between assets and invested capital. These are fundamentally different terms from the point of view by measuring risk and return on the assets. Non-operating land equipment and cash flows generated by those non-operating assets. What is important is that the non-operating assets or assets having a different risk exposure are also being valued separately. Okay, not all together. However, the balance sheet test for the insolvency purposes is a simple balance sheet test. So you have assets, you have equity, and you have liabilities. And from this point of view, of course, you mix all the assets, all the projects. Again, Engineer Lalka was perfectly explaining how companies can work with overvalued projects, overvalued investments. And of course, the balance sheet as such will not show this at the first glance correctly when there are other cash-generating projects keeping the company alive. It can be at the level of projects and or strategic business units. And of course, the projects can be using project finance. So also the capital structure individually applied to investments and investments projects can be different. So also the risk exposure is different. Financial accounting, as regulated under local gaps, does not go into this level of detail that is necessary for knowledgeable financial and business management, okay? Financial accounting, as we know it, was never meant to measure the value or the risk of companies, okay? This is a perspective which, again, is not looking at the real performance of individual projects in companies, and we get a very different picture to their performance and fair value, although it is not directly visible at the company level. What I would like to focus on is a case study. The case study is a real case study I was involved with as an expert witness, okay, when I was doing a real valuation. And I would like to show you what kind of implications, or maybe unintended implications, the over-indebtedness can have by revaluing assets at their fair value. So basically, these are the definitions. I think we can save time by explaining the definitions of over-indebtedness. Here, according to the Czech law, this is shown in the slide that it's applicable to both legal entities and natural person. It has two or more creditors, and the sum of all its liabilities, obligations, whether due to available or not, exceeds the value of all its assets, taking into account the reasonable anticipated proceeds of the continued business activity. So this is the so-called going concern principle. Again, what Dr. Richter already was talking about in the morning. This is the background narrative of the case study, and this is what I'm going to use as an example to show you which kind of unintended and negative implications can have when there are projects which, and here we are not talking about criminal acts, okay, or some like intended, trials to take assets out of the company. The narrative is very simple. There is a company called AB, okay? There are two shareholders in the company, 50-50, shareholder A and shareholder B. The company is engaged in industrial production, and a precondition for the sale is the spin-off of a non-operating asset. The non-operating asset I call freezer project, which the buyer is not interested to take over. Freezer project means, imagine you have a plant producing whatever, and at the site, this manufacturing company decides to build a big freezer, okay? And the company will sell the freezing capacity to other tenants which will be storing food and inventories or whatever, which needs to be kept under low temperature. Okay, so freezer project. The freezer project, of course, is a completely different area of business. Okay, so it is a completely different risk exposure than the original business. And the shareholder B, holding the remaining 50% in the AB, has no economic interest, okay, in further running the freezer projects. So the question is, what are the possibilities of separating the freezer project from the company AB before it gets sold fully to the other shareholder, that means the shareholder B, and what are their economic implications? It would be everything all right, everything correct, if only the project was creating value. So if the project was on the ongoing basis financially sustainable. However, in the reality, it can become very often the fact that you bet investment, you invest capital in projects which all of a sudden turn to be losing money. At the level of the company, you will not see that the project of the freezer is destroying value and losing money and generating too low incomes to be sustainable. Because there are other projects which are profitable. which are sustainable. However, the question is, how can you get rid of such a non-performing assets and what kind of implications this might have? And this is then the real testing of the value of the investment by a real transaction, or at least at the beginning by the valuation of the real market transaction. That means the most strict test of quality of the project you can imagine, because you have a real proof if it is valuable or if it is not valuable. So the option number one is to transfer the freezer project as a part of the business enterprise under a contract for the purchase of part of the business enterprise concluded between AB as a seller and partner A as a buyer. That means you take the real estate, you take the equipment, you take the employees, allocate it to this project, and as kind of strategic business unit, you transfer it. The option two is conversion by spinning off the freezer project under the Czech Act number 125/2008 on transformation of companies and cooperatives as amended. That means you basically separate the assets and the part and create an SPV which will be running the project on a separate basis. So this is the option number two. The option number three is transfer of individual assets, rights and liabilities belonging to the freezer project. That means you take the liquidation value perspective. That means, okay, how much would it be just to sell off the assets belonging to the freezer project and subtract the project financing? Because of course it is not, most of the times, fully equity financed. You also use debt to finance the freezer project. And all the options applicable in this case will not be possible if the value of the project is negative. So if it is losing money, or if the return on the capital invested into the project is not sufficiently high, no investors will be ready to pay the amount of money which is or has been recorded on the balance sheet of the company. And of course, it will have major implications for the company AB. When we look at the numbers, so we have operating assets, then we have the project, and then we have the total assets. Then we have the equity, debt related to the freezer. That means it's massively using, because of the proportion of real estate, debt financing, and the financial statements are according to the Czech accounting standards. The book value, and this is shown on the balance sheet, this is the book value, okay? So how much we spent on acquiring the assets belonging to the freezer project. The book value, as it is a new project, we can put equal to the new replacement value. And the question is, if it should be separated, that means to sold at a fair price. So what is the fair value of the freezer project? And then, okay, this is the calculation of the enterprise value. And this is the fair value of the freezer project if the cost of capital is higher than the cost of capital of the whole company, and if the free cash flow obtainable from the project, you see, is even positive. So basically what it says is that there is rent income coming in, however, it's not high enough to cover the cost of capital the investors would expect, which leads then to the equity value of the project, which is, considering the debt related to the project, negative. So if you would like to take the option number one, that means that you take it as a part of the business and you transfer it. This would basically mean that you have to report a loss at the level of the company AB, which will then potentially lead to insolvency of the AB in the form of indebtedness. So this option to get rid of the project would probably not be what you would like to do, would not be applicable. If we take the option 2, that means separation of the freezer project through spin-off, which would result in further existence of AB, whereas a part of its assets, the freezer project as part of the business enterprise, would be transferred to a newly created project company, and subsequently they would exchange the equity stakes. Then, if the project is not creating value, the equity would be at the beginning negative. So if the equity is at the beginning negative, someone else would have to come and recapitalize the SPV at a minimum level, which is necessary by the local law. So supplementing the registered capital of the SPV from other sources, at least to the statutory minimum level. And the third option, that means transferring the individual asset right or obligation belonging to the freezer project from AB to shareholder A. There we have material issues. This is the legal perspective. This is what I would like to skip. But then we have the economic issues, the sale price of the freezer project and the book value of the freezer project shown in the financial statements. And the book value is high, and the fair value investors would be ready to pay is low. So all of a sudden, you would generate a loss at the level of AB. So the result, again, possible insolvency in the form of over-indebtedness of the AB. So the concluding remarks I would like to make, because I am a little bit already under time pressure, right? I should finish in 5 minutes. So first of all, again, to repeat, the incompatibility of the going concern principle in accounting and the incompatibility of the going concern principle in financial valuations. Okay? In accounting, it's enough that the company can continue its operations. In financial valuations, to consider it going concern, it has to be financially sustainable and also cover the opportunity cost of capital. Otherwise, no rational investor carrying himself interest and cost of capital would not invest this amount of money in the respective project, okay? This is a matter of rational decision-making. In light of conservative nature, the Czech gap is not capable of adequately reflecting the economic reality. This is exactly what we saw on the examples from Slovakia and the Czech Republic, and this is what this very simple case study can confirm. An accent on the precautionary principle in the Czech gap doesn't allow a real identification of the debtor's assets and its value-generating potential, because all investments and all the values, and also in the area of insolvency, are forward-looking. We don't care how much was spent on the assets. We don't care how much is reported on the balance sheet. The question is, when I put my money at risk, how much return am I going to get in the future? Right? This is the very simple investor's choice. And this is not what the balance sheet is showing, and this is not what the balance sheet is and ever has been supposed to show. First of all, it is necessary to assess the fulfillment of the assumptions of going concern, and depending on its fulfillment or non-fulfillment, then to choose the appropriate methods for evaluation and its liabilities. So expert input is therefore needed not only on the cash flow test, but also on the balance sheet, that means the over-indebtedness issue test, because such information is not usually directly obtainable from the balance sheet. So this would be my, let's say, state-of-the-art remarks coming from my experience nowadays. How about the future? right? And I have 2 minutes left. So let me tell you my personal opinion about the future, how we are going to bypass the issues related to the quality of financial reporting and fraud in this area. And I personally see the future in the increasing importance of the technology of blockchain. Because when we report all the transactions in a dispersed blockchain, then basically no changes exposed in the statements, no abuse of information asymmetry, which is basically, again, the nature of the fraud taking place in the insolvency proceeding, will ever be possible. Because you see the information recorded in the so-called, or kind of, DNA of the blockchain. So this is a completely different quality of managing information asymmetry by having a higher quality platform where you record economic transactions. Right? You don't need then, for the future, accountants. You will not need auditors. Why? Because you have everything available in the real time, and if you are not credible, then you won't get access to the ecosystem. You won't get access to the blockchain. So this is not a question of the next 6 months or the next 2 years. This is, of course, a question for the future decades, maybe, but definitely as the computational power is improving and increasing, and as information is getting available in the real time, not only in business transactions, but imagine in the future how much more transactions undertaking by robots will take place. This is the Industry 4.0, right? Robots doing business with robots. And these are all the transactions you will have to report and record someplace, because it is valuable. Imagine you drive a car, and the car demands the information from the car 10 kilometers ahead of you. What is the temperature? What is the traffic? What is the weather? And the other car linked to the blockchain will send this information, and your car will pay by a fraction of Bitcoin. So of course this information is valuable, and you have to pay for, and you have to record it. So this is way beyond what we consider like the amounts of transactions today. So this is what will eventually lead us to vast automation and much, much improved risk management also in this area of insolvency issues. And such positively, I would like to end my presentation, and thank you for your attention and for staying so long and for coming. Thank you.